validation, now I validate myself. Building inner strength, putting doubt up on the shelf. No more unnecessary drama, no more wasted time. Climbing higher constantly, making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. Whoa. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. Yesterday, we covered a pretty deep topic, and I wish I could have had enough time to cover it even further because there was a lot more stuff that we could have talked about. Record highs on views yesterday. Really appreciate everybody who came from both Twitch, Twitter, and YouTube. Make sure that you guys like and subscribe because today we're going to be talking about active investing in gold, silver, and stocks. So we're going to be covering money today. Man of my word, I told you guys that. If in the event that you guys want to comment, you can either click the links that you see in the comment sections for Twitch, YouTube, and Twitter. I did that in reverse. And approve the mic, approve the camera. I'll see you in real time. Or if you would like to put your comments into the comment section, you can do so. And as you seen yesterday, even Twitch and Twitter can comment here. This is a multi-platform interactive conversation. So if you're watching me from Twitch or you're watching me from Twitter, you can very well hold a whole conversation with the people on YouTube because everybody's comments that are appropriately produced are up here, whether they're positive or negative comments. They just have to be appropriate. I'm not going to say that you have to agree with me for your comments to go up on the show. All I'm saying is that it can't violate the community guidelines. It'll go up there. We'll talk about it. recognize that we do have individuals that come to the channel that are not quite of the age of 18, but they do come here to learn some stuff, because this is an educational channel more than anything. We talk about real world events. We talk about this, that, and everything in between around those real world events, but we tend to tune things towards how it negatively impacts your day-to-day operations with making and investing money, saving money, and building a wealthy life where you can retire hopefully early and not have to be the manual labor slave that we've been being over the past several generations. This is more of a apprenticeship style podcast where we're going to teach you guys how to put your money in the right place so that you can make your money make money for you, so that you're spending less time and effort in making your money. As we talk about it, you guys are going to come to understand I'm actually doing it. So I'm not just recommending for the sake of taking up your time, because my time is money. I don't know about your time, but my time is money. So be that as it may, when I tell you guys, hey, you know, if you go and do X, Y, and Z, you could see you some profitable returns. Why am I telling you this? Because I see profitable returns. Okay. Now, recognize we're live 7 nights a week. We typically start around about the same time every night of the week. We're supposed to start at the top of the hour, but we tend to come quite a little ways after the hour, specifically because we operate on CP time. We got a lot of things going on, and we have to make sure that we have factual information before we start the show. So anytime real-time information changes what I was just about to tell you about, there's going to be a delay in the airing of the show, specifically because I want to make sure that what I'm telling you in the moment that I am telling it to you is in fact facts. This is one of very few podcasts that is a fact-driven, based on extensive research. So when I tell you something, you can take your sweet time and get on your Android or your iPhone. Most of y'all have iPhones, and ask the Google lady and see what she say. Google it, and you'll come to find out that pretty much everything that I've given you up here is exactly as I said it. And then some of the information that I gave you, I found in places you can't find it. And that's one of the reasons why I'm able to give you in-depth, interactive information that you can take action on. I don't expect you to just take my word for it and run with it. I'm not a seminar. I'm not going to convince you to give me money in order to get information. I'm going to give you this information for free. But if you're benefiting from the information that I'm giving you, I strongly encourage you to throw something at the podcast. Anything will help us, because the podcast isn't free, and the information sometimes is a bit costly. So with that being said, I want you to know that we don't let the sun rise without going live. And since we're here 7 days a week, we're talking about business and finance information on Monday, Tuesdays, and Wednesdays. Monday specifically, how the politics and government impacts your ability to make, save, and invest money. Wednesday specifically, we talk about where we're going to spend money in different countries around the world. Tuesday, which is today, we're going to be talking about how we're going to make and save and invest money. And then you see Thursday, Friday, and Saturday with self-improvement, social improvement, and other such things. So these are ways that you'll be able to find how to get in there and get your investment exactly the way you want it to be, and find yourself more so satisfied with what we've got going on. So let's go ahead and get things started. Today, we're going to be dealing with the active investing in gold, silver, and stocks. And this is going to be my June of 2025 game plan. We're in the middle of the month, but that's okay, because we're going to be talking about what we're doing going forward. So gold, we're talking $3,400 an ounce right now. Silver hitting 36-year high. And the stock market, well, let's just say, we're going to be honest, it's a bit of a roller coaster ride, blindfolded. And we're trying to navigate through that. Real quick, did you know that recently a trend has happened that silver is valued at 10% of gold, even though the demand for silver is just as high as the demand for gold? The value of silver is 10% of the value of gold. So when gold is $3,400, silver usually right around the same price at $34 to $36 an ounce. We're going to be getting into that in just a moment. But if you're an active investor, June 2025 is definitely not the month to be twiddling your thumbs. Nope. It is the month to have a plan, a rock solid plan, if you will. So forget just waiting to see what happens. This is about thinking things through and making moves. So over the next couple of hours, I'm not just going to skim the headlines. I'm laying out my precise active trading game plan for the gold, silver, and stocks right now for June of 2025. So this isn't just some theory. This is about how I'm navigating the current ups and downs and trying to position for potential wins. So the market isn't going to wait for us. This is going to be a true thing, and a good strategy shouldn't wait either. No idea that is a good idea is beneficial for you if you do not put forth any effort in executing that idea. You got to remember that. Now, let's get right into it. All right. So, what's the lay of the land right now in mid-June 2025? Well, dynamic is probably an understatement. Gold has been on an absolute tear, up a good chunk of year to date, recently hovering around $3,420. And it's been on this massive increase all year, because I told you that in January and February it was at an all-time high as well when we covered gold and silver. And when we talked about precious metals and precious minerals in May, we were talking about how gold and silvers were still on the incline. We even saw it spike higher thanks to some geopolitical jitters, which really just highlights its role as that go-to safe haven. This whole surge is being fed by a pretty potent mix between the inflation that just won't quit, central banks buying up big, and a global scene that's, well, persistently uncertain. Some folks are predicting gold could average $3,675 by year end, and a few even say hitting $4,000. But with prices this high and some technical signs like the RSL cooling off from overbought, there's a real debate about whether we're in for a breather or even a dip before the next climb. Then you've got silver. Silver, frankly, is electric. It's shot up over 20% year to date, trading around $36 to $37 an ounce, 10% the value of gold, and has smashed through some key resistant levels, reaching 13-year highs. The outlook is bullish. Some analysts are looking at $40, maybe even $46 or more. It's got a great story. It's a monetary metal, sure, but its industrial demand is just exploding, meaning that they're needing more of it to build things. So we're talking solar panels, electric vehicles, all kinds of electronics. They all need a ton of silver. We're actually looking at a fourth straight year where demand for silver is higher than supply, which is a pretty strong fundamental reason for prices to stay up. And what about stocks? The S&P 500 so far this year has been lagging behind gold and silver. So you can almost feel the caution from investors, where juggling ongoing trade talks, worries about tariffs, that stubborn inflation, and consistently shifting ideas about where interest rates are headed tend to be controlling decision making. While analysts still think company earnings will grow in 2025, there's a worry that this could get canceled out by pressure on stock prices themselves. Some think the market might just trade sideways for the rest of the year with limited ups and downs. Interesting, international stocks have been doing a bit better, which shows why it's good to spread your investment around. This kind of uncertain and choppy market is exactly why being a active investor isn't just a good idea, it's pretty much essential. One of the things we were talking about yesterday was how immigration laws, where they're forcing the forced immigration to take people and send them out of the country, is negatively impacting employment rates, and it's negatively impacting capital flow through the economy, which is negatively impacting big businesses and small businesses, which is negatively impacting American jobs, which is negatively impacting American incomes, which is negatively impacting the market. So we didn't cover yesterday's story to sit here and complain about what's happening in the country. We warned that there are serious things that are happening in the country that will negatively impact the day-to-day operations, but we more so covered the topic for the specific fact that where you would have put your money, you might not put your money, because as we talked about before, some businesses that used to thrive are now reconsidering closing their doors. Some businesses that used to succeed and excel are starting to struggle. And those markets, those investment opportunities are now having investors pull out of those companies early before capital losses start to occur. You notice that around about the 23rd or the 25th of every month, which is about a week from now, that you see yet another dip in the dividend stocks, where right now people are taking their money out of the stock market and putting it onto gold and silver, playing it safe because the market trends are not improving. TikTok was supposed to be bought 3 days from now, and I don't see that happening, which means we have another 90 days of tariffs, in addition to another 90 days of deportation efforts, in addition to another 90 days of retaliation from Canada, in addition to another 90 days of lost sales from the billions of dollars we would make from Canada. All of these things negatively impacts the economy in the short term. And while we're in such volatile waters, we have two ways that we can address this. One, we can ride the wave and continue doing our dividend rotation strategies like I was talking to you guys about yesterday. Or two, some of us can start playing it safe and buying into a stable, steady increase of gold and silvers. Typically, if your capital gains are that high, I would recommend preventing the loss by putting your cash somewhere where your money is going to make money for you. Well, the value of your stocks is going to make more money for you. And then when the market starts to balance itself out, you can sell your gold values for the capital increase and then put that back into the stock market. But notice that if all of the billionaires and millionaires are pulling all of their money primarily out of the stock market, while the stock market continues to be on a downturn, those of us that are financially challenged can still manifest a massive return, because as we continue to buy in and increase our principal investment, as soon as the millions and millions of dollars goes back into the stock market, that's when we're going to see our principal interest explode. So there's more than one way that we can go about doing this, but I want to make sure that you guys know that more than 2/3 of wealth managers agree that these kinds of markets are perfect for active management, which is why I started talking to you guys last month about active investment strategies. So this isn't a market for just sitting back and watching. This isn't a passive market where you just put your money somewhere and just let it do its thing. It's a market that practically yelling for an active strategy, a clean, clear game plan. So given where gold is flying right now, my strategy is all about cautious optimism and actively managing profits, with gold near $3,400 an ounce and after such a strong run, it's just smart to look at the signs. While the long-term reasons to be bullish, like macroeconomic risks and central banking buying, are still there, momentum indicators like the RSI have started to back off from those earlier overbought signals. So, what's the plan? First, trimming positions when things look strong. If you've ridden the big rally, taking some profits from your gold ETFs or physical billions isn't a bad move, especially if the charts hint a short-term tiredness or a possible dip towards support levels like 3,300 or even 3,245, as some short-term forecast suggests. Real quick, guys, I want to make a special shout out to Mr. Satellite. Mr. Satellite, it's been a while since you've been here. You missed out on a massive conversation we had yesterday. Let's throw up a special shout out for Mr. Satellite. My guy, we were talking about immigration. We were talking about the upturn in unemployment and the riots that are happening in Los Angeles that was putting everybody in a loss of employment for different reasons. Should have been here yesterday, bro, but Mr. Satellite is one of the guys that always comes to the show and shows us love. Him and Bayside. So I got special highlight intros for those guys. And really appreciate whenever he has the time to come through. Moving on, research clearly shows that easing back on gold holdings at peaks is a smart tactical move. Bayside hasn't popped in yet, but he should be. I'm expecting him to come today. I'm expecting Bayside to come today. He was here yesterday. He was here yesterday. So the tactical moves isn't about ditching gold. It's about managing risk and freeing up some cash. So second, hedging against a potential pullback. So I'm looking at using options, specifically buying put options on gold ETFs. Think of it as an insurance policy, right? Now, you have call options, where a call option is when you are offering to buy if it reaches a certain high, and a put option is when you're offering to sell when it reaches a certain low. If you're doing put options on your gold ETFs, even though you're betting against the market, so you see and believe that the gold is going to continue to rise. If you're doing a put option that says, well, if it takes a dip, I'll sell. Assuming that it does work out in your favor, individuals that buy into the put option ends up well, actually it's reverse. Call options say that you'll buy, and then put options will say you'll. No, I had it right the first time. Call options say you'll sell your stock. Put options say you'll buy the stock if it dips below a certain level. So if you're doing a put option saying, well, I'll buy more gold if it reaches a certain level in a downward turn, and call option says that I'll sell at a certain level if it reaches a certain high option, betting against the market. So if you're doing a put option and you're betting against the market, you're saying that I'll buy more gold if the market dips. Now, when you're doing option trading, there's usually a premium involved where you receive a certain quantity of capital regardless of whether or not the trade is successful. And you will notice that option traders that advertise that they can help you make money in seconds using option trading, this typically only works in situations where well, one, you've traded a lot, because you don't gain option trading status unless you've had a few hundred trades under your belt, regardless of the value of the trade. Secondly, when it comes down to option trading, typically option trading comes from, you have covered calls and puts and uncovered calls and puts. And when you have covered calls and puts, that means it's backed by something. So if you have covered calls, it's backed by the stock that's in your possession. If you have covered puts, it's backed by capital in your possession that can afford to pay for the trade. So they will put a hold on whatever stocks or capital that's related to that particular trade. Uncovered means that you don't actually have that possession, which allows you to still make the trade proposal, but you have to make sure that when the trade resolves itself, that you have the ability to satisfy the trade. Almost like gambling on credit. You have to make sure that you've got the capital because they're going to collect as soon as the trade occurs. Now, doing the put option, this is going to make you a little extra money because if gold is going to continue to increase after you've already bought the gold, if you're offering to buy more gold, if it dips, you will get a premium off of making that offer. It does give a security blanket for the gold stock ETF, but it also gives you a little bit of cash on the back end because each time you put up a put option and you don't have to execute on that put option, you maintain a larger quantity of profit coming in off of the value of your willingness to invest. So think, like I said, as an insurance policy. But if gold prices do correct, those puts gains value, which helps offset some of the losses in main gold positions, meaning that if in the event that the gold starts to level off, the put options expire out in your favor, where you're gaining capital off of the put options. The money that you would not be gaining off of the gold leveling off in its position, you will be able to maintain the perceived loss. And a perceived loss is that you're no longer gaining. That's how they look at the perceived loss, because it's not like the gold is going to dip and you're going to get a loss. It's just that you're no longer going to get a gain. And if you're not getting a gain, they consider that a loss. So this is a really key part of active risk management when a market has given you so much so fast. Now, the third thing is keeping an eye on key technical levels for getting back in or adding more. While I might be trimming now, I'm also watching for signs of consolidation and the next good entry point. Key support levels mentioned in analysis, like around 3,365 to 3,342, or even lower towards 3,271 to 3,300 area. While observing those levels, this will be a really good and important position to dive back in. Now, if gold holds these levels and starts to look bullish again, that could be the signal to jump right back in or add more. So we need to follow trends using tools like moving averages and the RSI to confirm which way things are headed. The longer term forecasts are still pointing up, with some analysis aiming for about 3,700 to 4,000. So the fourth thing that we're going to do is staying tuned to event-driven catalysts. Gold is super sensitive to things like inflation reports, central banking announcements, and any geopolitical flare-ups. So unexpectedly high inflation or rising global tensions could essentially and easily send gold rallying again. So being nimble enough to react to these events is vital. And being nimble means having some money available to throw down. On the flip side, if tensions ease or the Fed sounds more aggressively than expected, that could trigger the pullback, where we're expecting to see that pullback. So when things start calming down, the chaos with the immigration deportation settles down, the tariffs start going away, the Canada stops being a dick and starts taking American alcohol and stops taxing American on electricity, and all these things start, really dying down, where inflation stops becoming a problem, and we start seeing a lot more capital spending because our spending power starts to increase, our discretionary funds has further reach, that's when people will start pulling back off of the gold. And in that scenario, that's when you're expecting to have already sold gold at its peak so that you're not taking a dip in the gold values. So my gold strategy for June isn't about being all in or all out. It's about active management. So taking some profits off the table, protecting what I've gained, and strategically planning for the next opportunity based on clear technical and fundamental signals. Silver is where a big chunk of my active focus is right now. The setup is just too compelling to ignore. It's not just tagging along with gold. It has its own powerful story. As I mentioned, silver gets a boost from both being a safe haven asset, and crucially, from its strong and growing industrial use, especially in the green techs like solar panels and EVs. So adding to that persistent supply shortage, you've got a strong fundamental case where silver pricing right now around $36 or $37, breaking its 13-year high, tells you the market is definitely paying attention. So here's my active silver strategy for June. First, increasing my exposure. So I'm shifting some capital, possibly from those trimmed gold positions, into silver. Now, this can be through silver ETFs for broad exposure, or if you're comfortable with more risk, silver futures for more leverage. The idea is to tap into silver's strength and its potential to catch up even more with gold. Some forecasts sees silver pushing towards $38 to $40 and maybe even higher in the medium terms. Second, focusing on high quality silver mining stocks is definitely a good place to go. Silver miners can offer a leveraged way to play the silver price. If silver goes up by a certain amount, will run mining stocks can often go up by even more. I'm looking for companies with solid financials, efficient operations, and ideally exposure to growth in mining friendly places. So research points to silver stocks gaining more and more attention. Third is using option strategies for income and strategic buying. For existing silver holdings or silver mining stocks, selling covered calls can be a neat way to generate some income, especially if silver trades sideways for a bit after its strong run. Now, remember, I explained to you that covered calls is using the stock option that you hold possession of as leverage to offer a sale of what is currently being recognized as a growing stock. Since a covered put is having capital gains leveraged against the purchase of a stock that you currently don't have in your possession, if the stock drops, the covered call for silver and covered or uncovered put for gold is where you're supposed to be at right now with option trading. Because with the covered calls, the silver expecting to trade sideways, it is not expected to dip, but it's also not expected to increase high enough to match the level of cover calls, which gives you the ability to generate revenue without actually losing a lot of your silver shares. So you get a premium for selling calls, and if the price stays below your strike price, you keep the premium and your shares at the same time. So if the price shoots up past the strike, your shares might get called away, but at a profit. So it's a win-win. Now, I'm also considering using cash secured puts to potentially buy silver mining shares at lower prices. If the stock price drops below your put strike, you buy the shares at that price minus the premium you've already pocketed. There you go. So you just made profit off of the put option by buying lower stocks, and you made profit off of the call option by not having to sell the higher stock. If it stays above the put price, the put strike level, you just kept the premium there as well. Win-wins on both sides. Fourth, technical vigilance is the other thing that we're going to be working on. Silver has shown a classic stair-up pattern. So this is like a stair-stepping pattern where it consolidates, then makes sharp upward moves on strong volume. So I'm watching for resistance around the current $36 or $37 levels, with the next target potentially being 38 and then 40. So support levels to watch if there's a pullback could be around $36.45 or lower down towards $34.50. Just like with gold, using moving averages and the RSI will be key for timing entries and managing these positions. Now, silver's momentum is strong and it's backed by solid fundamentals. So my plan is to ride the wave actively using a mix of direct exposure and options to try and maximize returns while keeping an eye on the risk. Now, my next approach to stocks is in the vital market that we're dealing with right now. Navigating the stock market in June of 2025 really does require a scalpel, not a sledgehammer. So the overall market, like the S&P 500, is facing some extreme challenges. Those inflation concerns, ongoing tariff discussions, and potential shifts in interest rates really hurting the development of the S&P 500. Analysts do expect company earnings to grow, but this could be watered down by pressure on valuation. This whole situation just screams for picking stocks carefully rather than just broadly investing in an index, which is what we were doing with the dividend rotation fund. We were specifically picking high profit dividend stocks with low cost per share, where we would be able to buy low, sell after the ex-dividend date, receive a large quantity of capital from the possession of the stock during the ex-dividend date, and then potentially add that premium from the dividend to another investment opportunity. Also, what we were discussing was specifically buying certain monthly stocks, buying them low, and then adding to them with the profits from the dividend rotation strategy. Because if you catch certain stocks, like I've noticed a couple of the stocks that we're utilizing in our dividend rotation start to dip on the 23rd, which is next week. So between the 23rd and the 27th, when the stock is at its lowest, if we buy in then, we would be able to get the pinnacle value that we're looking for. Even though we're doing a buy and hold for this dividend stock because it's a monthly stock, being able to buy and hold that stock at that value gives us the capabilities of getting the most for our money. Where it is right now about 57% lower than the average before Donald Trump took office and caused the whole economy to take a dump, right? So when the tariffs fixes itself, when the economic downturns fixes itself and everything starts going back on an uprise, all of the stocks that we're buying after the 23rd of the month will double, triple, if not more. And since it was a buy and hold, the dividend payout on those stocks is going to be significant, considering the fact that we're not moving that particular quantity of capital. there's a different quantity of capital that we're rotating around, which also means that we can make money on two different fronts. Because remember, I talked to you guys, we covered this either last week or the week before, that money that doesn't move falls into a different tax bracket than money that continuously moves. Money that's in the same spot for 121 days ends up in a tax exempt status when it's less than $64,000 worth of profits from a head of household tax return and $97,000 worth of profits from a married tax return, right? So while the rest of the money is taxed regularly, you're making money make money for you. You're flipping money, moving money, investing money, and you're able to put your money in a place where by the end of the tax season, you're looking at a reasonable amount of profits versus a very low quantity of losses versus a reasonable amount of non-taxation, because a lot of your money is sitting still, right? Which is another active strategy. So active management in stocks is especially important right now. Some wealth managers really believe these kinds of markets favor skilled stock pickers. Well, if you know what you're doing, do enough research. Even if you don't know what you're doing, if you do enough research, you can figure this out, because this is advanced to intermediate trading levels, which means if you got a little bit of the beginners are learning how to buy the stock. The intermediate are learning how to sell the stock. And from intermediate to advanced is learning when to sell it and when to buy it so that you're not taking a loss. Once you've crossed that third hurdle there, you're in there with everybody else. The only difference is between the people who've been doing this for 20 years versus you is that you just started doing it this year. They've been doing it the whole time. But whoever does the most research on the right stocks is going to make the better trade. So here's my active stock strategy. First, sector rotation, which is a little bit different from dividend capture rotation. We're going to be doing sector rotation with thematic focus. So I'm prioritizing sectors that are either holding up well or could actually benefit from the current economic trends. So clean energy. Even though we understand that Donald Trump and Elon Musk and the battle between the two of them has sent clean energy into an uproar, these ties with clean energy are right back to the same level of the silver story. With the high demand of silver, who cares what Trump and Elon Musk is doing? Because the high demand for silver indicates the high demand for clean energy technology and development. So the huge build out of solar power and EV production drives a lot of industrial demand for the silver and other minerals, which leads to, if you're chasing silver, you're chasing clean energy. That's a partnering stock scenario. Companies in this whole ecosystem, from panel makers to battery tech firms, are definitely on my radar. Now, mining companies, beyond just silver miners, I'm looking at well-placed companies in other base metals or critical minerals that are essential for the green transition and general industrial activity. You can get into, we have covered this on the show quite a few weeks ago. All you got to do is go to the YouTube platform for this and that, because it's this, that, and everything in between. You go to the show, you go into the search section and just search precious metals or precious minerals, and you'll get both shows where we tell you every country in the world that has a precious metal and every country in the world that has a precious mineral that is undervalued, high demand, over the available supply, that you can invest in either by purchasing a physical asset or purchasing a stock or ETF of it. And you get all the information you need as to which one of these you should grab and where you should grab them from. I give you the values of the majority of them, the prices in US dollars. So it helps you, for those of you that are trading from America, know where to go to put their money. And which areas that you can invest in them, because you got some countries that requires a third party vendor to facilitate the trade. So I covered all of that for you guys. All you got to do is just scroll through the channel and look for it. But a defensive stock is going to be the other thing we're going to be doing, because when things feel uncertain, sectors like consumer staples, think grocery stores and healthcare, tend to be more resilient. Even though the grocery stores is being burnt to the ground in California, across the country, these staples are still resilient. So people still need to buy food and get medical care no matter what the economy is doing. So these can add some stability to the portfolio if you haven't already added that in there. Now, there is some international diversification that we're going to be adding in as well. US stocks haven't been doing as well as international ones recently, which is why I continue to cover different countries to invest in, different stock options to invest in. And guess what? Every country has a real estate market and a clean energy market and a tech market that is involving AI development. And that means that if it's not doing well in America, it could potentially be doing well in one of the other 200 plus countries around the world, where you could put your money somewhere else and still have your money make money for you. And we cover different country every week, every Wednesday. See you tomorrow. Now, make sure y'all like and subscribe as y'all fly through here. Exploring actively managed international stock funds or specific regional opportunities could offer some good diversification and a way to tap into different growth cycles, especially if the US dollar starts to weaken again, because he is about to spend $600 billion towards the debt, and we are not making $600 billion to cover the debt. He was supposed to have that sovereign wealth fund set up where the government's money was supposed to make money for the government so that the people wouldn't have to pay money towards the government. But that sovereign wealth fund has not been reportedly established yet, and the sovereign wealth fund has not reported any profits towards government spending. So they're really only spending tax dollars right now. And with trillions of dollars of debt, and he's about to spend 600 billion, and he only has 4 billion. So it's not like he's going to cover the cost. You got to ask yourself, what's the value of the US dollar by the end of the year? Second thing you want to make sure you do, you want to avoid too much exposure to highly cyclical or rate sensitive sectors. Industries that really depend on strong economic growth or super low interest rates might struggle in this climate. The same way real estate investment trusts are struggling to stay up while the interest rates are high due to the tariffs. And now the development of construction, so they have parts and materials that's going up, the lack of labor that is hurting the progression of real estate, and high interest rates that are making it hard to buy and sell. And since the cost of materials is going up, the cost of rent is going up. So you have like 4 or 5 different areas where real estate investment trusts have taken a massive dip. Only reason why I say for some of us it's good to dive into that is because for those individuals who are living from paycheck to paycheck at like 80 to 90% of your income, you could take a few $100s a month and put it into those real estate investment trusts, because they're not going away. But that $20, $30, $50 per share stock is now $6 to $10 per share, and it's still giving between 12 and 50 cents a share as a payout every month or every quarter, depending on which one you buy into. And if you're buying so low, when it goes back up to $30, $40, $50 a share, you'll have 10 times more valued stock than what you had when you started. And you're still getting the 12 to 50% per share value if you're buying this through ETF stock options, which ultimately means that if you bought in when it was valued at 6, now it's valued at 60. if you was getting 12 cents a share, you're now looking at $1.20 worth of payout. So if you had 100 shares at $6 a share, now it's equivalent to having 1,000 shares, which means that 12 cents a share might have would have gave you $12 when you had $6 a share, but now it's giving you $120 because you have $1,000 worth of shares based on your buy-in rate. This is how you're able to expand the growth rate of your capital. Now, sectors that rely heavily on discretionary spending or those carrying a lot of debt need a very close look as well, because when you're dealing with markets that are relying on high capital spending in places like California, where the curfew is shutting down all the nightclubs, you're ending up in places where people basically have to close their doors. Any establishment that is supposed to provide entertainment overnight is closing their doors before sunset and is not able to provide that service, which means they're not making any money at this time, which they have to redirect their business to daytime services until the curfews lift. Even though this might be a temporary scenario, temporary is relative, because a temporary scenario is that this isn't going to be forever, but it might consistently be until such time as the immigration aggressively snatching people out of their houses and off of their jobs stops. So that's a situation that you really have to pay attention to. So yeah, grocery stores are the types of staples that you can buy into, but individuals who are working less because there isn't a night shift anymore, they're not able to buy as much, so they're less likely to go shopping for clothes and makeup and perfumes. So you're looking at a large group of markets that are going to dip right now, at least as they're impacted by California, which I believe California is one of the biggest states in the country. So that's the largest dip that you're going to experience. The same way we received an extreme dip when California caught on fire for 45 days. Now, if California's rioting for 45 days, you see a big dip in discretionary spending. The third thing, focusing on companies with strong fundamentals and pricing power, meaning that they're going to control what they're going to be getting regardless of what's going on. In an inflationary world, companies that can pass on rising costs to their customers without losing too much business are in a much better spot. These are going to be places like Jordan, where don't nobody care what's going on with the market. If they don't steal some Jordans during a riot, they will pay $500 for a pair of fucking Nikes, because that's what the hell Jordan is. Jordan is a branded shoe produced by Nike. Okay. It is not a uniquely custom designed shoe that has no ties to any other shoe on the market. You go buy you a pair of high top Nikes, you just bought you a pair of Jordans at 10% of the price. I just want to throw that out there. You just don't have that little shadow of the black guy jumping with the ball like he's being chased by the police. That's the only difference in the shoes. But people will pay $500 for that shoe. So even in the current market, somebody will probably spend money here at the end of June before they pay their rent at the 1st of July, because the shoe is a limited edition. These types of commodities are things that you can actually invest in, because they're going to increase the price of the product to offset tariffs, to offset inflation, which actually contributes to the inflation. But consumer spending is not smart spending, which is why capitalism is based off of the poor, the weak, and the ignorant. Because if you can't do it, you'll pay somebody to do it. If you're too dumb to make a better decision, you'll buy something you shouldn't buy. And if you're poor, you'll do anything to get that money. These are the things Think about this. I experienced this most recently in the past week. I wanted to reduce the quantity of value in a stock without getting rid of the stock altogether. However, the quantity that I wanted to remove was more than 75% of the stock, which required me to dump the whole stock, but I still wanted to maintain possession of the stock. So I would have to sell the stock and then the very next day buy a portion of the stock back at the lower rate. In order for me to do that, I can't buy the stock back with the capital that is still unsettled. I have to have capital available to buy the stock back at the lower rate while the unsettled cash is still in the processing phase. So it's still got to have capital on hand to make a trade like that. Because you could see a scenario where you have a high profited stock that may have took a dip. You might be doing a tax trade where you're selling under the value that you bought in, taking that capital loss for a reason, up to $3,300 where you could be tax exempt on it. But you're turning around and buying back in with a lower amount because you know that this is year to date kind of taxation, not trade to trade kind of taxation, where by the end of the year, by you buying lower than what you originally was bought in, you might could make back the money that you lost and still turn a massive profit in the long run, because this is not about a overnight rich scenario. This is a long-term, month to month, year to year, generation to generation style scenario. So this is not only going to protect capital, but also give you the cash on hand to jump on more attractive opportunities as things change, which also means that if you see something that you originally didn't notice, like when we were doing the dividend rotation strategy over the past month or so, we've come to notice other stocks that we could invest in that would make the dividend rotation strategy more attractive without losing out on high profits. In order for us to buy into those stocks, we may have to buy into two different directions at the same time, or within close proximity of one another, where having two sets of capital rotating out is in our best interest. So the stock market isn't just one big thing. Within all this uncertainty, there are pockets of opportunity. And my active approach is about finding these pockets, focusing on resilient sectors and strong individual companies, and being quick enough to adapt to changing conditions. So one of the more subtle yet pretty powerful tools in an active precious metal strategy is trading the gold silver ratio, where this ratio simply tells us how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has swung around a lot, but it tends to drift back towards a long-term average. As of June of 2025, different reports put this ratio at pretty high levels, say around 90 to 1 or 94 to 1, somewhere in that area. And this is through, even though it has come down from earlier highs of above 100 to 1, you're looking at 90 ounces of silver to 1 ounce of gold. 94 ounces of silver to 1 ounce of gold. So the historical average over the past century is closer to 50 ounces of silver to 1 ounce of gold, or 60 ounces of silver to 1 ounce of gold. And the natural ratio in the Earth's crust is even lower, y'all, which is around 17 ounces of silver to 1 ounce of gold. That's science for you. When the ratio is high, like it is now, it's generally suggested that silver is undervalued compared to gold. And this creates a strategic opportunity. So here's how I'm working the gold silver ratio into my June 2025 game plan. First thing we're going to do is strategic allocation, shifting. With the ratio currently high, like above 80 to 1 or 90 to 1, the main strategy is to favor silver over gold. This means, as I've mentioned, I'm thinking about selling some gold or putting less new money into gold and buying more silver. The idea is that the ratio will continue to normalize or mean revert, meaning silver will outperform gold, causing the ratio to fall. And recent market actions has actually seen this happen, with the ratio compressing from over 100 to 1 to the low, and this was in the low 90s, showing this trade is in play. So we're targeting ratio normalization. The goal is to hold more silver relative to gold while the ratio is high. Then, as the ratio falls towards its historical average, say around 70 to 1, 60 to 1, or even lower than that, then I'd potentially revise the trade, selling some of the outperforming silver to buy back gold. The aim is to end up with more of both metals or to lock in profits in dollar terms. Either way, I'm doing good. Leveraging with mining equities is a very good strategy, because this strategy can also apply the mining stocks. When the gold silver ratio is high, it can be a signal to lean more towards silver mining stocks compared to gold miners, as silver miners might give you more bang for your buck if silver prices catch up to gold. Now, monitoring the key ratio levels, with high ratio levels, 90 to 1 or above, continue to favor silver. Increase exposure to silver mining stocks is something that we need to do. When median ratios is 50 to 1 or 70 to 1, positions might become more balanced, and I'd focus more on individual fundamentals of each metal. Options could be used here to play the volatility. And lower ratios, when it's something below 40 to 1, where historically this would suggest silver is getting overvalued relative to gold. At this point, one might think about converting silver back to gold or reducing exposure to silver miners. Research shows that ratios dropped to 35 to 1 back in 2011, which was about 14 years ago, when silver almost hit $50 an ounce. The gold to silver ratio trade is definitely an active one, and it means keeping an eye on the relative prices and being ready to rebalance as the ratios move. Given where we are in June of 2025 with a higher ratio and strong fundamentals for silver, this remains a key tactical reason to lean towards silver. In a market defined by sky-high precious metals and unpredictable stocks, having a solid risk management plan isn't just a good idea. It's absolutely essential. So active investing isn't about making wild bets. It's about calculating moves. And a core part of that calculation is how you protect your money and your profits. So here's my approach to hedging and risk management for June of 2025. I told y'all we're covering the whole spread over the next hour. So if y'all have been taking notes, and this show is on active replay, so if I ever throw something into the comment section for you guys to write down, you can always go back and rewatch any of the shows that we have on Tuesdays about investing, and you can get all of the stock information that we put onto the comment section in real time, which gives you the ability to see exactly what you missed out on last week or last month, because this stuff is always going to be beneficial for you. I figure I don't even archive this stuff. I figure that this information is going to aid you in your ability to make decisions, even if prices change, because once you get the strategy down, you can apply this for the rest of your life. This allows you guys to make money for yourselves, and the ability to become higher value men based on your ability to make more capital with less effort is more effective for you. And ladies, if y'all are here watching the show and y'all are learning how to make yourselves millionaires, because y'all don't need a man to make money, y'all can listen to a man tell you where the money came from and where the money should go, so that you can do the same thing. Because as I've told y'all before, that if two people got together and pooled their money together, that a family income of $100,000 could still put $40,000 a year into stocks and make millions within 10 years. So there is no reason why a relationship with two financially savvy individuals can only last 1 year, 5 months, and 6 days if y'all was focusing on making y'all money, make money for y'all. So since most of us understand it, at least in the United States, if not in other areas around the world, that most of us deal with roommate situations. If we built trust, not ethical trust, legitimate trust, where we put our money into a trust contractually owned by the trust, and the investment opportunities are set up where the trust is run by a trustee, whether it's a third-party trustee or one of the individuals that are in the trust, where the trust is designed to make money for the group. You and another buddy that's roommating in an apartment together, that's fiscally saving and investing y'all money, can put y'all money into a position where y'all can get paid out as beneficiaries off of that trust. It don't have to be a romantic relationship. It could be you and another family member. It could be you and your best friend. Anybody who doesn't be broke anymore can take the volatility of 2025 and put yourselves from working from paycheck to paycheck, chasing a dollar, to living off of the profits of your investments. If you don't, I don't know what to tell you, because in 5 to 10 years, this podcast is still going to be here talking about the millions that we made. And I told you so. But the rest of y'all are going to be sitting here wondering, man, how did you do that? I want to do that too. You should have been following this channel. Like, subscribe, and follow. Share it with somebody you know who can put their money somewhere better than the poor choices that they do with their lives. Now, one of the things we're going to be dealing with next up, right, for the hedging, we're going to use strategic options. So as I touched on in the gold and silver section, options are a big part of my risk management. Protective puts for gold, buying put options on gold ETFs like GLD or AI or IAU. So these are the ETFs. I told y'all I'm going to give y'all some stuff if y'all want to get into these, and I'm gonna throw into, don't worry, I got y'all Twitter, I got y'all, I'm gonna throw this in there for y'all as well, but y'all gonna see the replay on YouTube, because they don't throw the comment section in the so if y'all are watching on Twitter, make sure that y'all like and subscribe on YouTube, because you will be able to replay this video on YouTube. And in the moment that I started talking about this, you'll see it in the comment section that these are the things that we should be paying attention to. So gold, GLD, or IAU can help guard against potential sharp drops from its records highs, right? So if gold prices fall, the value of these puts should increase, softening the blow, meaning that the lower the stock market gets, the higher the put value is going to be. So if you buy in, you're buying in for less, which saves you some money. And then when the stock market goes back up, you're going to make a gain, a larger gain. It's like getting a discount on buying a stock because you're offering to buy it before it's being sold. Covered calls on silver and silver mines. When you're selling covered calls against existing silver positions or silver mining stocks, brings in income, which is the premium. This can boost returns if prices move sideways or creep up a bit, and it provides a small cushion if prices dip slightly, meaning that when you put your stocks up for sale, you get a premium off of that. And if in the event that the market goes sideways, you don't sell the stock, you made money off of the call. And if the market dips, while the stock value might have lost lost a little bit of capital, the money you made off of the call option offsets the money you lost in a depreciation of the stock value. That also hedges losses. Now, cash secured puts for silver stocks. This is a strategy that lets me earn a premium while waiting to potentially buy silver stocks at a lower price. What this does is you put up a value of cash. This is a covered put which is why you need to always have cash on hand. You put up a value of cash to cover the value of the quantity of stocks you're offering to buy. And if the stock gets down to that price, you buy it. You get the premium. But it is a way to set my entry point and get paid to wait. Because if you're putting up the put option and you're waiting for it to hit that strike point, you know that this is the level you want to buy in at. So you're going to buy in anyway. And until it reaches that point, your put options are going to pay you out as long as the stock hasn't reached that amount. And that's utilizing a covered put. Diversification is going to be another thing we're going to be doing to protect our investments. The old faithful, while I'm bullish on precious metals, especially silver, I won't go all in on one thing. The old saying, don't put all your eggs in one basket. Diversification. You need to have a little bit of money in a lot of different places. Because while I know that you're thinking, if all of my money was in this one spot, when this one spot spiked, I would have made more money than what I am making right now. What you need to pay attention to is that if that one spike with the largest majority of my money was to tank, I would lose the most quantity of money in my investment portfolio. That's why diversification is a key. Yes, it is fantastic to have a large majority of capital have a spike, but it is catastrophic to have that same large quantity of capital disappear. So you don't want to have all your money in one location. You want to spread it out. And then the percentage of money that is experiencing the spike should offset the percentage of money that's experiencing a dip, which means that you still average an increase. That is what you're looking for, an overall portfolio of increase. Because volatility is still volatility. Now, across asset classes, we want to keep a balanced allocation of metals, select stocks, and even holding some cash or things like short-term bonds in crucial locations. And short-term bonds are like 3-month bonds, 1-month bonds, cash bonds, not cash bonds. Well, cash bonds, treasury bonds is what I meant. Like when you're buying the US Treasury bonds, and they have anything under a year, they have those that are right now averaging at like 4%. You have the ones that are 2 years or above that are averaging between 4 and 4.5%. Last time we looked at it about 30 days ago, and that hasn't changed any. So the difference between buying 5 years or more and buying 5 years down to 1 month is almost nothing. There isn't an increase in interest rates if you're buying longer term bonds. So if you can buy a treasury bond for a short-term treasury bond, you can buy a treasury bond for this quarter. If you bought a treasury bond for this quarter when everything sucks, then you get the payout after because remember, if you're buying bonds and CDs and stuff like that, you only gain after the maturity of the bond, meaning that the time period has elapsed. If you take the money out before the time period has elapsed, you lose out on a percentage of it because it's a penalty for taking the money out early. So if you put the money in there for a short period, you can gain off of the possession of the bonds in the short term while you're offsetting the volatility of everything else around the bonds. Then when you get the capital back, you can either put it back into another bond or put it into gold, silver, or other stock areas. Now, this ensures that if one asset class suddenly tanks, the whole portfolio isn't dragged down with it. So within asset classes, even within stocks, diversifying across different sectors like clean energy, defensiveness, and international stocks helps manage risks. As a matter of fact, when we start talking about defense, I gave you guys off the wall locations where outside plastic doing wonderful right now. Y'all should have been invested in plastic. I gave y'all money for the local law enforcement y'all can invest in, prisons y'all can invest in, schools y'all can invest in, different markets all over the place where there's nothing that operates in this country doesn't have a freaking stock option to it. And you could be investing in a lot of things. Cybersecurity, everybody's trying to make your houses safer. Cybersecurity, booming market right now. And that's in the tech industry. If you put your money in stocks where you put your interest in life, you should be following a market trend because you're part of the market trend. Research consistently highlights how valuable diversification in tricky market environments benefits investors. So you want to also remember position sizing. This is very fundamental. No single trade should be so large that it could wreck the portfolio if it goes south. I decide to position sizes based on how volatile the asset is and my overall comfort level with the risk. If you're depending on how diverse your portfolio is, you're looking at anywhere between 5 to 20% of your portfolio is in any one location at any one time. The smaller the percentage, the more diverse your portfolio is, the better it is for you, because while you will see an increase somewhere, the percentage, if that tanks, is less than the full totality of your stock option. So you want to pay attention and follow through in a very, very strategic pattern. Now, setting up stop losses mentally or actually, this is something that you need to pay attention to as well. So for active trades, especially in more volatile things like futures or individual stocks, knowing your exit point if the trade moves against you is vital. This could be a technical level on a chart or a percentage loss you're prepared to accept, meaning that as soon as you start seeing this particular dip, you're out so that you don't take an even further impact. Just like when the real estate investment trust started dropping from $8 and $12 a share down to $7. Once it got down to $7, you were out before it got down to $6. So you did not lose as much as those people who had it at 19 lost now that it's $6. Big deal, big difference. Because when you lost $13 a share and you had 1,000 shares, that's a lot of money to lose. Okay. Now, you want to have regular portfolio reviews and rebalancing. An active strategy needs active monitoring. I typically pay attention to it every day, at least once a day. And I pay attention to it every day, once a day after the stock market is closed, because my information and my decision making is going to be made in the moment that I am observing the stock. If the stock is going to change after I look at it, any decisions that I made this morning might not be the same this afternoon, depending on what you're investing in. But whatever decisions that I make tonight, right now, the market's not going to change until in the morning, which is why you see a lot of stocks change, massive increases or massive dips after the market closes, because a lot of investors do this. They schedule trades for the next market day. So first thing in the morning, 6 a.m. in New York time, 6, 7, 8 a.m. New York time, you see all the stocks take a big shift first thing in the morning. Then it does the fluctuation throughout the day. So I'll be regularly checking my allocations. So if, for example, silver significantly outperforms and becomes a much larger slice of the portfolio than I intended, I'll look to rebalance, maybe taking some silver profits and moving them to an area that underperformed. And now, looking like it's better value, I can just go back into it or just put the money in cash and just sit on it until I'm ready for the next investment trade. Staying nimble and adaptive requires you to have capital that you're sitting on that's not actively in a trade, because you cannot jump on a purchase if you have no available capital. You can jump on a sale because you have available stock, but you cannot jump on a purchase if you don't have available capital. So the market conditions of June of 2025 aren't set in stone. So geopolitical events, economic data releases, and shifts in central bank policies can change the picture quickly. And I cover a lot of stuff that really directly impacts the way we make, save, and invest money, which changes the discretionary availability of capital in the average consumer, which changes the spending ability of the average consumer, which changes the reception of profits of the average business. Which changes the shareholders' interest in those businesses, which changes the way we invest. So I'm not going to come here and cover a topic where it's a bit sussing. For what? I don't care how the world's burning. What I care about is how I profit from it. Heartless, I know. But if you're focusing on what the Kardashians are doing, are you making money? Because I know they are. Think about this. It's all about how it directly impacts you. So how many children Nick Cannon got ain't got nothing to do with you. But if Nick Cannon goes and buys a Resvani, I might want to buy me some Resvani stock. Look now, this game plan isn't a rigid set of rules. It's a framework that allows for adjustments, being ready to change course, cut losses, or press winners based on new information, which is what successful active management is all about, especially when markets are choppy. Risk management isn't about avoiding risk entirely. If you did that, you'd avoid potential returns too, because the higher the risk, the higher reward. So you have to dive into the volatility with the willingness to take a loss so that you can come out of that volatility with massive gains. Those individuals that bet on Bitcoin before Trump got elected doubled their profits when it went from $50,000 to $100,000. Now Bitcoin is hanging out during the lowest parts of the year at close to 100 grand, which means that in the current trend, by September, by October 31st, it could be close to 150 grand. If you didn't buy in January, well, if you didn't buy in November of last year, you missed it. But if you didn't buy in April of this year, right after the 4th of July is probably the last time you're going to buy in at its lowest point of volatility. And it's going to be on a steady incline through October. And then after that, right around Halloween, that's going to be the next felt dip, right 2 weeks before Thanksgiving. And then another dip right after Thanksgiving, before Christmas, and then another climb right after Christmas before the end of the year. These are your buy-in points. If you don't pay attention to that, you're missing it. You don't have to have $150,000 to buy one Bitcoin. You just need $1,500 to buy a percentage of a Bitcoin and catch it while it's down. If you catch it while it's down, when it goes up, if it goes up 50%, it goes up 50% for you. It's just not going to go up $150,000 for you. If you bought in with $1,500 and it goes up 50%, you gain $750. So don't think about the bigger picture. Think about micro investments. It's about understanding the risks, getting a handle on them, and then using strategies to bring them down to an acceptable level that you can afford to invest in. This allows for confident investing, even when markets feel a bit wild. Having a strategic game plan is one thing, but making it work really comes down to tactical implementation and being able to react to what's happening in the market in real time. So in June of 2025, with so many things up in the air, this is especially true. So here's how I approach event-driven trades and the practical side of putting this active strategy into action. First thing we're doing is monitoring key economic data and policy announcements, inflation reports like CPI and PPI, these are huge. If inflation numbers come in hotter than expected, it usually gives gold and silver a boost as inflation hedges. On the other hand, signs of cooling inflation might slow down their rally, at least for a bit. Central bank meetings and statements, Fed, CBC, or ECB, and others will put us in a position where what central banks say about future interest rates and monetary policies is a massive market driver. Hawkish talk can strengthen the dollar and put pressure on metals. Dovish talk can do the opposite. Employment data, which is what we were talking about yesterday, jolts, non-farm payrolls. These are areas where strong job markets might give central banks more leeway to keep rates higher for longer. Weakened labor markets could signal an economic slowdown and lead to calls for rate cuts, which is usually good for gold. Geopolitical developments. Unfortunately, when global tensions are still a factor, any escalation can trigger a flight to safety, pushing money into gold and silver. Conversely, any significant de-escalation could see some of the fear premium disappear. This means that while the tariffs are such a big talk about, while Elon and Trump are pissed off at one another, energy is such a big talk about, y'all got some of the most volatile scenarios where y'all can be buying into stuff while all of the billionaires are running from it. Because when they're running from it, guess what happens to the price of the stock? Shit drops. So for everybody else who couldn't afford it, now the stock makes more sense to you. You can afford to buy into it now. Then when all the rich people come back, because they're going to come back, because what happens to the stock? It goes up. And if you're in it when it's down, when everybody else puts their money back into it, you could do the exact opposite. You let it go as high as it's going to go. And then when it starts leveling off, you sell it and you walk away with a little bit of capital, because when everybody else was running, you were the ultimate opportunist. Trade policies and tariffs in the news, where ongoing trade negotiations and any tariffs, including the TikTok sales, or removal of old tariff rules, directly hit stock market sentiment and can ripple through currency markets and commodity demands. The same way, as soon as those tariffs hit, we had a 700% dip in the S&P 500s. Utilizing technical indicators for timing, or coming to this show and I'll tell you about the timing. If you're following the trends with moving averages, I use moving averages like the 50-day and 200-day to identify and confirm the main trend for gold, silver, and specific stocks or sectors. And I generally prefer to make entries in the direction of the established trend. Momentum confirmations with RSI, which is relative strength index. The RSI helps me gauge how strong a trend is and spot overbought or oversold conditions. An RSI above 70 often signals things are overbought and a pullback might be coming, while below 30, it can indicate oversold and a bounce might be due. Currently, RSIs for gold is around 52 to 55, and for silver around 58 to 60. This suggests neutral to bullish momentum, but not extremely overbought. Volatility and range indication with Bolingering bonds. So Bolingering bonds, where these bonds can help spot periods of high or low volatility and potential price extremes, trading a fade from the bands, selling at upper bonds and buying at lowers can be a strategic range in the market, you would be able to see a upturn if you do that correctly. Though it's less useful in strong trending markets, in a fluctuating market, it is a strategy that can aid you in being a little bit more successful. Volume analysis allows us to use strong pricing moves that happen on high trading volumes, which are generally more significant and reliable than moves on low volume stocks. This helps confirm breakouts or breakdowns. Silver's recent breakout, for instance, has been on higher volume during its up moves, which is a bullish sign. Executing pair trades, where the main example here is the gold silver ratio trade. This means taking position in both gold and silver at the same time, like going long silver and short gold, or just adjusting physical holdings based on how far the ratio is from its historical norms. Then I'd rebalance as the ratio moves. Now, practical options implementation. Covered calls. If I own 100 shares of a silver ETF or a miner, and I think I might just trade sideways for a bit, I can sell one call option against those shares to earn some premiums. With our cash secured puts, if I want to buy a particular stock, but at a lower price, I can sell a put option at the desired strike price. I'd set aside the cash needed to buy a share if I get assigned. Buying puts for hedging. If I have a decent sized gold position, I would buy put options on gold ETFs, picking a strike price and expiration date that lines up with my risk tolerance and how I see a potential correction playing out. Being an active investor means being an informed and responsive investor. And it's about having your indicators set up where your news feeds constantly monitored and your plan ready to adjust as the market story unfolds. And if you have a very positive relationship with your partner and they know about investing and spending and money and balancing things, you will find yourself in a situation where instead of y'all arguing and fussing about bullshit, y'all could be sitting there either talking about how delicious total cereal is, or y'all could be talking about which market has shifted, which stock option has changed, and which investment opportunity might be feasible for you guys to look into. Because while $97,000 is a tax exempt area for married couples, it makes more sense that if, ladies, the fella talks to his woman about where he's going to put the money at and get her opinion. So if you know what's going on with the money, please, ladies, learn what the freak is a Bitcoin. So, because if somebody asks you the difference between a Bitcoin and $100 and which one will you take today, if you say $100, you should just drown yourself in a river, because it makes absolutely no sense that you're going to throw yourself in a position that you are giving up hundreds of thousands of dollars for the fictitious idea that a coin has less value than paper. That never happens. A coin has more value in more situations than paper. Okay. It just depends on the fragmentation of the coin. Do your research. Do your research on money. Do your research on currencies. Do your research on currency exchange. Do your research on investments and stocks. You can make yourself a millionaire. You don't need a man, but if you're in a relationship with a man, you want one that makes financial decisions that is satisfactory to your expectations. So you need to know how to make yourselves financially successful, and you need to know that you're dating a person that has the same intent. That way, y'all got something to talk about. Y'all ain't arguing about who left the toilet seat up. You're discussing where your money is going. You start planning for family, children, all this other stuff. Y'all can make those plans a whole lot easier if both of y'all have a financial goal to meet. That gives you the ability to meet those goals. All right. Let's quickly pull together the main pieces of this active investing game plan for June of 2025. A month that's looking pretty exciting with 6 sky-high gold, eerie silver, and unpredictable stock markets that I have been giving you guys over the past month. Gold strategy with gold nearing record highs of around $3,400 per ounce. The name of the game is caution. This means trimming some profits and these high levels and then hedging against potential downsides with put options. Keeping up a close eye on key technical indicators like the RSI, currently neutral to bullish, and support levels for any re-entry or further adjustment. The long-term picture still looks good thanks to macro risks, but active management is absolutely key. Silver strategies. Trading strong around $36 to $37 and breaking multi-year highs is a real focus. The plan is to increase exposure through ETFs and carefully choosing silver mining stocks. I want to capitalize on its strong industrial demand, thinking solar and EVs, and its appeal as a monetary metal. I'll also be using option strategies like covered calls and cash secured puts to generate income and potentially pick up shares at good prices. The stock strategy in the stock market needs a selective touch right now. The focus is on rotating into sectors like clean energy, which is benefiting from the demand from silver, which links nicely, and the resilient mining companies and defensive stocks like consumer staples and healthcare. International diversification is also on my mind. So the broader market might just trade sideways, making active stock picking really important. Gold and silver ratios is key to tactical planning, with the ratio historically high, currently around 90 to 94 to 1. The strategy is to continue favoring silver over gold, expecting it to move back towards its historical average, which is nearly 50 to 70 to 1, where 50 to 70 ounces of silver to 1 ounce of gold was the before level. 90 to 94 ounces of silver to 1 ounce of gold is the current level. You're looking at it dropping 20 to 40 points or 20 to 40 ounces of silver valued towards gold. That's what you're preparing for. This means allocating capital accordingly. Remember risk management, where this is not negotiable. The plan includes using options for hedging and income, maintaining diversification across different asset classes, and within them, disciplined positions. Sizing the values of your stocks is critically the flexibility to stay nimble. Adjusting to the new economic data, policy shifts, and geopolitical events as they happen. So when we're dealing with the chaos that happens in California, you're looking at your stock option. You're not looking at the jackasses throwing stones off bridges and busting windshields and potentially getting shot off the bridge from the sheriff. You're looking at the businesses that are potentially not going to be functioning for 3 months because of the curfew. And you're looking at the investment portfolio as it would impact your ability to invest in those businesses. That's what you're paying attention to. This isn't a set it and forget it kind of plan. It's an active framework for navigating what's proving to be a complex and fast-moving market. The key isn't to stay informed. That's what you really want to do. You don't want to just stay informed. You want to stay disciplined, because you don't want to make emotional and impulsive trades. Just because they set a mall on fire doesn't mean that you need to take all your stock out of the mall. It just means that you need to pay attention to how the actions of the last 2 weeks impacts the stock market overall for the rest of the month. Then you want to be ready to adapt if necessary. Now, before we wrap this up, the standard is very important for me to cover real quick, just a bit. Got to let you guys know that while I am not a financial advisor, and this live podcast is for information and educational purposes only, the strategies and options I've talked about here are my own and are based on my interpretations of what is happening in the market as of June of 2025. And if you've been following the podcast over the past 9 months, you've come to understand that I have not been wrong. Everything that I tell you is going on and is beneficial for your attention. Investing in financial markets always involves risk, including the possible loss of your initial investment. So you want to always do your own thorough research. And if you don't have enough knowledge or skill set involved, it's always recommended to talk to a qualified financial advisor before making any investment decisions. And remember, past performance doesn't guarantee future results. So that is my game plan for tackling these electrifying markets in June of 2025. But what about you? What are your strategies for gold, silver, and stocks right now? Are you seeing the same opportunities, or maybe focusing on different angles altogether? I want you guys to make sure that you drop your thoughts and your questions and your own game plans in the comments below. I read every single one, and I'm really keen on hearing your perspectives. I also respond to as many of them as possible within a 24-hour basis as it stands. Once you guys overwhelm me, I'll be able to respond within the week. But for the most part, Mr. Satellite, Bayside, and All-Star, to name a few, can confirm that when you guys drop a comment in the comment section, I definitely respond to that. So let's get a good conversation going on this. And if you guys found this breakdown useful and want more active trading strategies and market analysis, make sure that you hit that subscribe button on YouTube, the follow button on Twitch, the follow button on Twitter X, like the show, and make sure that you come back every night of the week, because you will be able to see the next update as to what we've got going on with stock investments and political shifts that negatively impact our ability to make and save money. And if you ever feel like this has ever given you a lot of value, you could always throw some contributions towards your channel, which aids us in our ability to not only gain the information, but also gain a little bit more reach to inform more people on things that you guys will pay $350 an hour for a financial advisor to tell you the exact same stuff. Where, think about it, I've been live for about 2 hours now. You guys just saved $700 by getting the information from me for free. I just want to let you know that real quick. Navigate, and we're going to do this 7 days a week. Tomorrow, we're going to be talking about a different country to invest in, because remember, I told you that world trades is something that you need to take interest in. And then Thursday, Friday, and Saturday, we're going to be talking about personal improvement and personal development, because if you change the way you live life, you'll change the way you spend money. And if you change the way you spend money, you'll have more money on hand that you can utilize to invest in your future, where the retirement is that you don't need to work and all your bills are paid, and you have extra spending money on the side outside of your investment portfolio, where you're living off the interest of the principal. That is when you retire. And if you have enough money where you can travel the world and live off the interest of the principal, where all your bills are paid, that's when you have really been able to retire, because not only are you living from payout to payout, you're also able to travel the world and enjoy life and not have to worry about where your money is coming from. which means you answer to no one besides your own personal calendar for trades. That's where I want everybody to end up at. Because if you understand, we have almost 1 million people fired this year and things are looking up. And on the side of that 1 million people being fired, we have technology advancing where more machines are replacing humans in manual labor workplaces. We are going to be leaning towards a country that is going to be more heavily driven towards less physical workers that are not in technology, and people still have to make profits somewhere. So if you're not about to go back to college to be a tech major, you're probably going to have to put some extra effort and extra skills into making money doing something else, working for yourself or having money work for you. So navigating the investment world for June of 2025 with gold at historic highs, silver catching fire, and stocks on a pretty unpredictable path takes more than just hope. It takes clear, accountable strategy. An active approach focusing on careful analysis, tactical moves, and solid risk management is, in my opinion, the best way to not only handle the volatility, but actually seek out the opportunities it can create. The markets will keep changing, but with a solid game plan, you're much better equipped to make informed decisions. So I want to thank you guys for watching the video, and I really appreciate you guys coming to the show today. I want you guys to make sure that you like and subscribe, and note that the sun doesn't rise without the show going live. So you're going to see us every night of the week. I want you guys to take the time to share this with somebody that you know that needs it, somebody that you know that'll argue against it, because I take all challenges, because everything I do is packed with information. With that being said, I want to thank you guys for coming to the show. Ladies, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So ladies, please make it make sense. Special shout out to those of you that's watching us on Twitter X, and special shout out for the rest of you that's watching us on Twitch. Red Void, Omni 81, Danny, Stefan, I really appreciate you guys for swinging around. Outside of that, thank you one more time for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow night.
Higher ground. Used to chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. Standing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds, raising the bar, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.